Welcome to the Mills Knows Bills podcast. My name is Mills Bender. I'm the founder and CEO of Mills Knows Bills, where we help you, variable income earners, master your money in 90 days. The point of this podcast is to help you make the most of your fluctuating income so you can stop living paycheck to paycheck, pay off your debt twice as fast, and get on track toward reaching both your personal and professional financial goals. Now, as I continue to grow my team here at MKB, you may have some guest hosts from time to time. However, our goal does not change. Whether we're bringing in a guest speaker, having an in-depth conversation about our personal finances, or talking about a topic that is of interest to you, our goal is to help you master your money. Welcome to another episode of the Mills Knows Bills podcast. I'm your host as well as founder and CEO of MKB, Mills Bender. On this podcast, we answer business owners' burning financial questions. We typically have guests who join me. I'll answer their question, let them go on their merry way and implement it into their business. However, I've been getting asked lately, Mills, you always talk about analyzing your P&L. I don't know where to start. I don't know what that means. I don't know what I'm looking at. It's just a page with a bunch of numbers. So I figured, you know what? Let's have a short episode where I give you a little P&L analysis 101. There are 4 components that I want you to take into consideration when you're looking at your profit and loss, because regardless of what industry you're in, you're typically going to have all 4 of these components. Everybody's going to have revenue. Cost of goods sold, you will have if you are not a service-based business. Sometimes your bookkeeper will catalog certain things in your cost of goods sold, and that's fine. Your operating expenses, and then your net income or your profit. So what is revenue? Revenue is also called your top line. And when you're looking at your profit and loss, some things that I want you to ask yourself is, do I need to diversify my revenue? I have a couple of clients who have most of their revenue coming from the same 1 or 2 clients. And if you have more than 50% of your revenue coming from one client, that's not a sellable business for you. You want to make sure that you are diversifying that revenue because it's incredibly risky. The second thing I want you to look at is, how do I increase my revenue? What area can I double down on? What area is maybe making me money, but the effort to make money over here is actually taking away from the possibility of making revenue elsewhere in my business? And then the last thing I want you to ask yourself is, do I experience any seasonality in my business? I know for a lot of service-based business owners, especially the coaches and content creators that we work with, they experience seasonality in their summer months. The reason being, a lot of people are going on vacation. And for whatever reason, we have it ingrained in our brains that when it's summer months, we slow down, we turn off a lot of the output that we're tending to do. And so as a result, those service-based business owners tend to experience that slowdown. So if you already know that you have that seasonality, what you can do is make sure that you set aside extra money in advance of that dip in your revenue, as well as plan to implement bigger projects or scaling opportunities during those months, since you already have the time on your hands. Don't freak out over it. You know it's coming. Just make sure that you plan for it. Okay. The next component is cost of goods. So cost of goods, or COGS, is directly related to if you have revenue or not. For example, if you are a reseller, you're only going to have the cost of purchasing that item if you also have the revenue of selling that item. So that's typically for product-based businesses. You want to look at how much of your revenue is being eaten up by your cost of goods. So the total amount for your cost of goods divided by your revenue, look at that percentage, and then compare that percentage to your competitors, to nationwide averages. See if you are over or under that percentage, and then make decisions from there. If you are a blue collar business owner and your cost of goods is directly related to your vendors or manufacturers, when's the last time you talked with them about your rates? When's the last time that you negotiated with them? Use that as an opportunity to negotiate. The third component is your operating expenses, or OpEx. These are typically your fixed expenses in the business. So whether or not you make revenue, you're going to have to pay for those expenses. Why do you need to know this? Well, number one, this is the dollar amount that you should be focused on a month over month basis and what you should be basing your emergency fund off of. If you are a business owner who does construction, right, and you don't have any projects to do, but you still need to make payroll, you need to make sure that you have that money set aside. Also look at that as a percentage of revenue. And then you want to make sure that as your revenue increases, your operating expenses are not increasing at the same rate. So if month over month your revenue is increasing by 20%, your operating expenses should be increasing at less than 20%. You see, when investors look at how viable a business is, whether to invest in it or buy it in the long run, they look at their operating expenses out of revenue. And if you are increasing your operating expenses, that means you're not really being efficient with your money. The reason being, there's three ways that you can spend your revenue in your business: operating, investing, and financing. And so if you have most of your revenue being eaten up by your operating expenses, there's not enough left over to go towards areas that actually expand and grow your business, which is investing and financing opportunities. So you can increase your operating expenses by hiring more people, putting more towards marketing, whatever it may be, but make sure that it's not at the same rate that your revenue is increasing. And then lastly, your net income. So you have revenue minus cost of goods sold minus operating expenses gives you your net income or profit, however you want to talk about it. That's all the money that's left over. Now, a couple things I want to make you aware of is somebody will often look at their profit and loss and they'll say, why do I have $50,000 on my profit and loss as my profit, but nothing in the bank account? Where did all that money go? Your profit and loss will not show your debt payments. So if you have a payment that's going towards your cars or maybe your credit cards, that's not going toward the payments are not being reflected on your profit and loss. Only the interest is being reflected on your profit and loss. So back out any debt payments that you've made from that profit. The second thing that you want to back out is any owner's draw or distribution that you've taken. Those will not be reflected on your profit and loss either. So I had a client the other day who's had $75,000 of profit in the first 6 months. She asked me, well, where is all of that money? She doesn't have any debt in the business, but she has taken $75,000 in draws. She's kept pace, and that's not healthy either. So you want to make sure that you are backing out your debt payments as well as your owner's draw to make sure that you're not leaving your business bank account with nothing. What is in your net income is also the amount that's taxable. So as a business owner, and I'm going to say this with a grain of salt, okay, because this is just a 101 class, okay? Whatever your profit is, multiply that by 25 to 30%, and that's how much money you should have set aside for taxes if you've not been making tax payments throughout the year. The last thing you want to look at is how much of your net income is revenue. Look at your percentage. You want to see your profit margin. You want to see how profitable you are and make sure that you're comparing that to industry standards as well. I have a client who wants to outpace the rate that is industry standards. For his company, which is in construction, it's about 15%. He's not satisfied with 15%. 15% is his version of doing poorly. Really, what he wants to achieve is 25%. So we are working on financial strategies in his business to make sure that he can go from his current rate of 20% to 25% over the next 12 months. I hope that this little P&L analysis 101 class was helpful to you. If you have any additional questions, or maybe you're interested in applying to hire us, you can visit our website, millsknowsbills.com. Thank you so much and have a great day.